ladies and gentlemen, and welcome to the webinar series of Barjeel Geojit Financial Services that we have been doing regularly over the last 14-15 months. And we have restarted this from April again, where we are trying to do a session every 2 weeks. And what a 2 month it has been. When we started early April, India was, with reference to India, with reference to COVID and the second wave as we speak today, was almost not spoken about. And when we did our second session, we just had the second wave and then we spoke of the lockdowns. And now we are in the series in the midst of lockdown in various states of India. And also things seem to be now getting back to normal. And yesterday, I think, was in spite of all this, the corona being at the background, the markets have touched its new highs once again, both with the Nifty and Sensex. A lot of things have happened over the last few months, and especially once the corona issue started way back in March of 2020. And life for all of us has changed dramatically, whether you are in service or whether you are in a manufacturing setup or in whatever work we do. And the markets have also shown us great resilience and movements and volatility. We have seen all of it in the last few months. And again, we are at a phase that there is still concern in terms of where this economic recovery of India is going to happen and how soon it is going to happen. I think the confidence level of the recovery that we face, all of us think, is quite high. And when and how it is going to happen is the question that most investors are asking us, especially considering the fact that over the last few months, the markets have moved up in spite of the news flow that has been happening from India today. In order to talk to us about his perception about the markets, its present state, and what can we expect in the future from an India growth perspective, we have one of the best minds from India today. I think we can't find a better person than Mr. Prashant Jain to talk to us. Thank you very much, Mr. Prashant Jain, for taking time off and to talk to our investors today. It's wonderful to have you back today and hear your perceptions. I remember the candid meeting that we had the last time when you, whatever you said, most of what statements you made and what you expected and anticipated have all come through. And I think our investors are eagerly looking forward to hear you again. I must also at this juncture welcome all our clients from Muscat, Bahrain, and Kuwait who are also joined this webinar. And let me also tell you before we get into the session that please do not ask any stock-specific questions. I don't think Mr. Prashant will answer those questions. You can ask any questions relating to the sector and what you feel about the macroeconomic questions that you may have about the markets and other questions. Please put your questions on the chat box. We will pick up a few relevant and try to address as many questions as possible. Let me at this juncture take a minute to introduce Mr. Prashant Jain. Mr. Prashant Jain is the Executive Director and Chief Investor Officer at HDFC Mutual Fund, India's leading mutual fund. HDFC Mutual Fund's asset under management is over INR 4,015 billion, of which around INR 1,800 billion is in equities and equity-oriented schemes as of April 2021. Mr. Jain has over 30 years of investment management experience. Mr. Prashant holds the distinction of being the only fund manager in India and one of the few globally to have continuously managed a scheme for over 27 years. This fund, namely HDFC Balanced Advantage Fund, earlier known as HDFC Prudence Fund, is the largest equity-oriented scheme in India and has delivered a CAGR of 17.8% since inception till April 21. Mr. Jain has completed his postgraduate PGDM from IIM Bangalore in 1991. Before this, he has obtained a bachelor's degree in mechanical engineering from Indian Institute of Technology, Kanpur. Mr. Prashant has worked with SBI Mutual Fund as well as Zurich Mutual Fund in different capacities. He moved to HDFC Mutual Fund subsequent to the takeover of Zurich India Mutual Fund by HDFC in 2003. Over to you, Mr. Prashant, and we look forward to a very interesting session for you. Thank you.
Thank you, Mr. Ramachandran, for a very generous introduction and very good morning, good afternoon to all of you friends. And I also thank Geojit Barjeel Securities for giving me this opportunity once again to share some thoughts with you. And I'll speak for about half an hour. And so that we have more time for discussions. So I will take the help of a small presentation that has 10-12 slides. Now may I request the moderator to kindly take us on to the first slide. Thank you. You go down, yes, one slide, please. Maybe you could do it on a full screen, please. I think, yes. Yes.
First slide.
Oh, yeah. Could you move down one slide, please? I could go straight to the subject matter. One page down, please. Yes. So this is a snapshot of how the economy is behaving in the second lockdown. And what has happened between the first and second lockdown is very interesting. I think most businesses and households are better equipped, experienced, and prepared to continue to lead a reasonably normal life in this kind of environment of lockdown. And most businesses continue to operate this time around. And this is showing up in the various charts that you see here. The Oxford, there is an index called the stringency of lockdown index. And you can see that the lockdown stringency is lower this time around than last time around. And more importantly, the demand for power is fallen very sharply. You can see in April 20, the power demand was quite low. It had fallen almost 40-50%. But this year, the power demand is holding up reasonably well, and it is down very marginally from March, April levels. Railway freight tonnage movement, you can see, is quite holding up very extremely well. Unemployment has again spiked up slightly, but compared to last time lockdown period, it is much lower. And you can also see that the economy continues to function nearly normally by the tax collections. And last year in April, May, they had fallen to as low as 5.7 billion per day. And currently we are holding about 14 billion a day. I think the economy continues to function reasonably well. And this is what has been experienced in other countries like the West as well. And this is probably one reason why in the second lockdown, equity markets world over have held up quite well, unlike the first time when it came with a shock and the economic impact was far higher. Yes. Next slide, please. This is a snapshot of the how the economy has behaved in this very difficult periods. And clearly, fiscal 21, the last year, was a very difficult year. And for the first time in many decades, the Indian economy contracted. We always used to take pride and say, even in the years of Lehman or Asian crisis or 9/11 or even tapering Brexit, Indian economy was extremely resilient and it had demonstrated growth in each of these years. The lockdown was too strong to withstand and the economy contracted for the first time by almost 8%. Current year, the growth is estimated to be roughly 10%. It could move down slightly depending on how long the current lockdown lasts. And also the growth this year is slightly misleading. It is largely a result of the very low base of last year. So if I were to summarize this in one more way, I think these 2 years, fiscal 21 and 22, would represent a period of virtually zero growth for the economy, which is a very a unique kind of a situation for a otherwise secularly growing economy like India. We do hope that by fiscal 23, which is next year, growth rates come back to normal. And not just normal, we think we are hopeful that growth rates will actually cross what we have grown in the last couple of years. And I will share with you some thoughts on that as to why it is likely. The chart in the middle gives you the various quick economic indicators. And you can see once again that most of the economic indicators, the power demand, the railway tonnage movement, some of these I have already shared with you. But by and large, the economic impact of the current lockdown is much lower than what was experienced last year. The chart at the bottom demonstrates or shows that the metal prices, this is a global commodity, this does not pertain to India, rather it pertains to the entire world. The metal prices have gone up extremely sharply, and now actually they have crossed pre-COVID levels. And this was most counterintuitive. It came as a surprise to almost all of us, and the exact reasons for this are still being debated. And even the sustainability of these current prices is a topic of discussion, and there is no consensus there. I think some of the factors that could have contributed to this is the fact that post Lehman, and because of the very challenging conditions in capital markets and also in the economy, the capital expenditure cycle has been extremely weak post Lehman. So few new capacities have been added. And along with that, the current strong rebound in demand conditions, the focus on infrastructure spending by many governments across the world, and also income transfers to lower sections of the society. And when money is transferred to lower income groups, it results in more commodity intensive consumption. I think these are some reasons why demand has bounced back and supply is probably constrained. One, because of underinvestment in last decade. And I think also there are certain challenges in terms of producing to full capacities in the various parts of the world because of certain restrictions or challenges around logistics, etc. There could also be an element of pent up demand. You were building a house, it got delayed. You were building a road or a bridge, it got delayed. And now suddenly you are trying to make up for lost time. So, how much each one is contributing, probably it will never be known. But this was an interesting development, and how at times developments can be most surprising, most counterintuitive. I thought it was a good example, and therefore I thought it appropriate to share with you here. Now, moving on to the next slide, I think this is an interesting slide, and this is unique to India. India, for all the progress that we have made, continues to remain by and large a low income country. And what is, if you look at the income distribution of India, uh, the 75% of families in India earn less than 30,000 rupees a month. And these are the bottom two, the white and the yellow and the black, portions. 75% of families in India earn less than 4 lakh rupees a year, or roughly 30,000 rupees a month. The challenge this creates is that these large number of people in India therefore have low savings, and when income is disrupted for this section of people, it creates a serious challenge. I think the impact on many of these people this year will be more than last year for three reasons. Last year, one, since before that life was normal, you would have had some savings. Disruption in incomes in last 1 year would have led to depletion of your savings, number one. Number two, the support from the government last time around was a lot more. This time around, the support is less. And third, this time around, because the prevalence of COVID infections are more and the need for hospitalization is far more this time around, I think the health expenditure is also a lot more for many of the impacted families. And therefore, put together, I think this time around, the impact on these families, low income families, will be more than last time around. The reason why it might not have significant impact on economy this time around is because the purchasing power is extremely skewed in a country like India, and the bulk of the purchasing power resides with the top 10-20% families, especially for the discretionary goods and services, and which is what is more relevant for the large or the listed companies. And that is why the impact on stock markets is probably even lower. Just to give you some sense, uh, just about 10% of Indian families own a car, and just about 5% families in India have access to air conditioning. So that tells you how discretionary consumption is concentrated in the top 5, 10, 20% families. And therefore, in view of this, I feel the social impact of the current lockdown is probably more than the aggregate impact on the economy and on the large businesses. A large number of these low income families are employed in the urban services sector. And you can see here that services sector accounts for almost 37% of employment. And this black line is slightly misleading. The smaller circle on the right actually refers to, it breaks up in detail only the services portion or the blue portion of the larger circle. So kindly look at it like that. And you can see that most of the service breakup is concentrated on the urban areas. Basically, when the top 5, 10, 20% rich or high income households spend on services when they step out, go to a shopping mall, do some shopping, entertainment, eating out, travel, tourism, health, spas, salons, whatever. So it is when this top layer spends, income is generated for a large number of other low income families. And since these section of people are not stepping out clearly, the impact on the incomes of the 40 odd percent people employed in the services sector is likely to be considerable. So, and the same theme is also represented in a chart below, and this is what has been experienced even world over. And this is an indicative chart, and this is from CMI. It shows that the recovery is much higher in incomes of the higher income groups than of the lower income groups. And this is similar thoughts have come even from countries in the West, and this is quite logical and intuitive as well. As I think Manish Sabarwal of Team Leads put it, that we are all in the same storm but not in the same boat. So I think that's a very apt way to describe the current situation. That while everyone is in COVID, but the impact is disproportionately more for the lower income groups. And I think I will also explained why in aggregate this matters less for the economy and for the stock markets. So in summary, I think this time around, this is more of a social problem and less of a economic one. Yes. Can we move one more slide, please? Yes. I think the while COVID has caused deep challenges for the country and especially for the large number of impacted families, I think there have been some positive developments of COVID as well, uh, at least on the economic front. The first and foremost, as a reaction to COVID, lockdown, challenging economic conditions, governments world over have lowered interest rates, and there has been significant fiscal and monetary stimulus across the world. India, as a developing country, always depends on flow of capital towards it. I mean, to its to especially to invest more in the economy. The investment needs of a developing country are far more than that of a developed nation. Because of the low interest rates, surplus liquidity, huge liquidity, the flows towards EMs and especially India have been extremely good. And you can see that in the chart given here. And also the cost of servicing external debt will come down, which is good for a country like India that is a net borrower. I think the second development, which is in fact a bigger one, is what happened in COVID, because COVID impacted the supply chains in China, and the world was over dependent on for manufactured goods on the supply chain in China. I think the disruption caused created an urgent need in the buyers to de-risk from China to develop at least one more source. I think the shift in manufacturing away from China, which was more gradual earlier and which was taking place due to reasons of cost, I think the disruption caused due to COVID accelerated that pace of shift. And I think India is likely to be a significant beneficiary of this environment. The government of India, realizing this, uh, I think has acted timely, and they have come out with the PLI scheme. This is called Production Linked Incentive Scheme. So essentially, the government is incentivizing setting up of manufacturing facilities in India for targeted products, the ones we consume but don't make, and where if you make them over time, hopefully you will be able to export some also. So you can see there is a fairly large budget for cash transfers, cash subsidies, support, various categories of products. And I think given the comparative wages in India, availability of skilled manpower, technical manpower, availability of land, labor, water, power, and above all, a massive local market, which is an advantage which is not matched by other Asian peers like Thailand, Vietnam, Indonesia, Malaysia, Bangladesh. They have some of the advantages of a low cost structure, but what they lack is a large domestic market. So I think with the PLI scheme, we are beginning to use these advantages productively, and hopefully this will lead to a increase in India's share of global manufacturing. We have completely missed the manufacturing opportunity last time around. Though India is a leader in the services market, but manufacturing, we lost that opportunity to China. But I think that opportunity is knocking once again, and hopefully this time we'll be able to capitalize on it. This is a very important theme. So I thought I'll share with you one more slide on this. Could we move one slide, please? This is you can see that in the top left-hand side chart, that how China's share of global merchandise has gone up very sharply. And you can also see that in the last few years, their share was becoming stagnant. It was not increasing, it was slowly coming down. And this was happening for reasons of cost. And you can see that how India lags big time in manufactured exports, and our exports, manufactured exports, are just about the same as much smaller countries like Vietnam, Malaysia, and Thailand. The chart in the middle left-hand side is, you can look at it as glass half full or half empty. It tells you how we have lagged China, and it also tells you how there is a big opportunity. This chart in the middle left-hand side gives you a per capita GDP ratio of India over China. Sounds hard to believe, but till late 80s, early 90s, India's per capita was same as China. And what a difference 30 years can make. And today, China's per capita income is 5 times of India. This has happened because they have grown far more rapidly. They have made a much bigger impact, much bigger share in global manufacturing. And of course, as economy has grown, per capita income has grown. But today, their per capita is 5 times of us, and this is what is giving us the second opportunity. and India's wages are much lower than China, and China is the highest in Asia, and that's why manufacturing was moving away from China. The It is not just cost, but also the environment for doing business that is extremely important. And Indian government realizes this, India realizes it, and therefore the country has been working on multiple areas to improve our ease of doing business rankings. And I think we have some progress to show there. So our ease of doing business rankings have improved from 142 to 63 in the last 5 years. We aim to be in the top 50 in the next few years. And now our ease of doing business rankings are better than Vietnam, which is a significant achievement. Our gap with China has narrowed, but we still continue to lag China, so which shows we have some more way to go. So I think manufacturing is a very large opportunity, and if we can improve our share here, it will not only improve our GDP growth rates for many years, it will also reduce our balance of payments deficit, and above all, it will provide large employment opportunities in very large numbers, which is the need of the hour in India, because India is an extremely young country and there is an urgent need to provide meaningful employment opportunities to a large number of people. So this is a very important development, and what would have happened over 5-10 years, I think COVID in a way has accelerated that shift. Yes. Could we move on, please? Next slide. I think one more fallout of COVID has been that, I mean, we have seen it in the past, both in India and outside India, that difficult decisions are taken in tough times. Difficult reforms are carried out in tough times. And if you look at the history of reforms in India over the last 3 odd decades, every reform, most reforms were a result of some difficulty in the environment, and virtually you were left with no other option but to reform. The opening up of the economy was a result of the balance of payments crisis. The capital markets reform was a result of the security scam. The reforms in coal, telecom were a result of the challenges in those areas. The IBC was a result of the severe stress in banking. So when there is a challenge, you end up changing something. I think COVID also created a serious challenge for the economy, and therefore this period has been a period of important reforms in the country as well. I don't have a separate slide on the reforms, but let me just highlight few of the reforms that have been carried out. I think one important reform was of course, IBC is known to everyone, and I just mentioned to you the PLI scheme, which is a very big reform. And one more reform which has escaped headlines is the focus on privatization of PSUs. So in this budget speech, the Honorable Finance Minister and also the Prime Minister in subsequent interactions with investors and with media, the word privatization was used very boldly, very transparently. And the government said that we will privatize PSUs, good PSUs, successful PSUs in many areas. They have retained a few strategic areas, but in other areas, there is a commitment to privatize. I think this is a very important reform because when you privatize large successful companies, it enhances the competitiveness of these companies. As previous experiments like Hindustan Zinc, etc., tell us, it makes these companies more efficient, and it gives the government a lot of resources to invest in areas of infrastructure, social or otherwise, and also it reduces fiscal deficit. So I think this budget also marked a clear emphasis on capital spending. And for the first time in many years, we saw government's allocation towards infra spending going up, which is what is presented here. I think because of the need to support the economy, governments across the world, including in India, have increased their allocation towards capital spending. That is one clear shift. And there is this national infrastructure pipeline, which is talked about quite significantly. And that these two have improved the outlook for capital expenditure uh, in India, especially from public through the government. On the other hand, what is also happening, there is a welcome improvement in corporate profitability, especially in the core areas of the economy, the capital intensive areas. The chart at the top gives you how corporate profits to GDP has behaved in India. And you can see corporate profits to GDP has come down extremely sharply. This was mainly a result of the falling profitability in banks that were grappling with corporate NPAs. It was a result of falling profitability in the metal companies because commodity prices were weak. It was a result of falling profitability in some other capital intensive businesses like power or textiles or even chemicals, etc. What we are seeing now, there is a sharp rebound in the profitability of most of these capital intensive businesses. And when businesses make money, when they are profitable, when balance sheets are healthy, that is a very conducive environment for private capex to revive. So I think this is a very interesting, very optimistic, very positive development, that revival in the profitability of metal, power, chemical, textiles, paper companies, basic industries, I think will lead to a revival in private capex as well. So I think the environment for capital expenditure, for capital formation in the economy is better post-COVID than it was pre-COVID. And this is the second reason why we are more optimistic on the economy. Of course, interest rates are extremely low, especially compared to pre-COVID levels. And this is what also facilitates or improves the viability of capex going forward. We move to the next slide. So, to summarize, I think the while COVID has indeed created a somewhat challenging economic environment over last 2 years, more last year than this year. I think the at least in India, the outlook for growth is better post-COVID than pre-COVID because of a favorable external environment due to the manufacturing opportunity shift from China, due to low interest rates, and also due to local conditions around some reforms taken by the government, the focus on infrastructure spending by government, and the likely revival in private capex. And in fact, now even companies are telling this to us, the engineering companies, the construction companies, that they are more optimistic on the order flows. Moving on to the equity markets, I think this rally in the markets has taken most people by surprise. I think while we never endeavor to time markets in the short term, and that's what we publicly say, and we believe in strongly in that, that equities are extremely hard to forecast short to medium periods. But given the very sharp correction that the markets had seen last year, and you can see last year, if you look at the chart here, markets had fallen to a market cap to GDP of 46% at COVID bottom. Whereas more normalized market cap to GDP for India is between 80 to 100%. And this is what had prompted us to say that markets are good for investment last year around. And what we have experienced is that timing the markets is extremely difficult because sentiment, news flow, developments can change without any notice, without any expectation. But what we have also seen is that returns in stock markets are have a very high correlation with the prevailing valuations at the time of investment. So if you simply buy at reasonable or undervalued markets over time, the returns should be good. And if you buy at expensive valuations, even though the environment may be very conducive, your returns are likely to be mediocre or moderate over medium to long periods. So our optimism on the stock markets last year was basically a result of the very low prevailing valuations then, as also the belief that the economy and life would normalize over time. But most people have found this rebound surprising. So let me try and explain why the markets are not being irrational, at least in our opinion. Point number one, I think, as you can see from here, the chart, the despite the sharp recovery in the markets, at current levels of the index, India's market cap to GDP is not excessive. It is we have traded at close to these levels between 80 to 90, 80 to 100% in many years. So the markets are not an outlier going by the past experience. Clearly, they are not around 60, 70% also, but they are not very expensive either. The second issue is that if you look at the returns of the markets over last 10 or 15 years, the CAGR is around 11% only, which is around the nominal GDP growth of the markets over this period. That is again telling us that despite this rally, the markets are not excessively valued. I think the third point here is that I think it is not mentioned here. Apologies for that. But the impact of a loss, see, a lot of people are focused on the shut shops, the deserted streets, and some impact on profits of businesses. But it is interesting to note that the impact on fair value of a business or the impact on DCF value of a business of 1 year profits are zero is just about 5%. The stocks are, they represent the expectations or the discounted present values of future cash flows over 10, 20 years. So if a business makes profits, let's say 100 rupees every year, and for 1 year the profits are zero, the impact on fair value of that business is just about 5%. I think that's an extremely important point, that while COVID may impact profits of some businesses sharply for 1 year, the impact on the value of the business per se is just about 5%. The second point here is that the fall in the interest cost or the cost of capital has probably even offset that little impact of loss of 1 year or fall in 1 year's profit. I think if you keep these two things in mind, it helps you explain what is happening in markets, not just in India, but actually world over. What has also happened in India is the profit growth of businesses has actually been extremely healthy. This again is most counterintuitive. And if you look at the chart, the table here, you will see that in fiscal 21, which was the year that experienced the first lockdown, you will see that the Nifty EPS growth that year was extremely healthy, almost 16 odd percent. And it was the best year or the highest ever Nifty EPS growth in last several years. This is a result of some sector specific factors, which I will come to shortly. But I think what has also happened in this period of lockdown is that the large organized businesses have benefited on two counts. One, they have gained share from their smaller counterparts, because smaller companies were unable to either produce or to reach out to their customers because of weaker, organizational structures, access to technology, etc. So larger companies by and large have gained share. And the second is this period, the larger companies especially were also able to control costs quite meaningfully. Wage pressures were not there. The promotional expenditure, travel expenditure, overheads were not there. Non-essential expenditure was curtailed. So I think most businesses have achieved significant cost savings. And these two factors have also supported a strong profit growth in India. So the expectation at the time of lockdown was that profits will collapse. That clearly did not materialize. And right now, if you look, the outlook for growth for even the current year is an extremely good one. In fiscal 22, the estimate for Nifty EPS growth is almost more than 30%. And this again is the result of the likely sharp fall in provisioning costs of the large banks. Let me now move on and share with you some thoughts as to why the profit growth has been so strong and what is supporting this profit growth. So I think on the table at the bottom left hand side, we have given you some sector specific factors that have made this possible. Banks are benefiting from lower provisioning. Last 5 years, some of you may be aware that banks in India were suffering from high level of corporate NPAs, and but over the last 3 4 years, most of these accounts have been provided for, or recovery has been completed under the IBC, the Indian Bankruptcy Code. And as these provisions are coming down, there is a sharp rebound in the profitability of these banks. Fiscal 21 saw considerable benefit of lower provisioning, and the full normalization of provisioning costs will be visible in fiscal 22. That is why this is a strong contributor to above average Nifty EPS growth both in fiscal 21 and in fiscal 22. IT sector benefited from both some sense of urgency in customers to adopt to make their businesses fit for the digital world, and also due to lower costs, low travel, low promotions costs, and very low wage pressures. The FMCG sector by nature continued to grow steadily. Even here, the margins expanded because I'm sure the media spends, etc., were brought down. Capital goods, they did feel some impact, but the impact of lockdown was felt here quite a bit. But still, I think in the engineering companies, this time around, the uh, economy continues to function. The impact is likely to be less. Healthcare, by definition, was not much impacted. Metals, I have explained to you, we discussed metal prices are extremely healthy. So metal companies are making record profits. Utilities, this sector by definition has less impact. It mainly refers to the power sector. There was some impact for a few months last year, but utilities in India are a controlled ROE business. They don't sell in the merchant market. Rather, they have long-term power purchase agreements with the distribution companies with a fixed cost recovery model. So the impact was actually quite small. Telecom sector is not impacted. People data consumption continues to grow, so that is supportive of this sector. Cement again benefited from lower costs, even though volumes were slightly impacted. So by and large, the way Nifty is composed of, one third of Nifty is banking, one third of Nifty is global businesses, and the discretionary consumption and the engineering companies which were impacted are a relatively small part of Nifty, just about 20 odd percent. And this is why profit growth has done quite well. See, the pain in the economy is more in the services sector. Let's say physical retailing, multiplexes, airlines, tourism, and these sectors don't have much weightage in the stock markets in India. And this is one reason why there is significant impact on low income growth by way of employment, but the equity markets are not feeling that pain. So the composition of the stock markets is somewhat different from the underlying economy. And the chart at the bottom right hand side gives you the weak profit growth sector wise over last 5 years, and the likely healthy profit growth between fiscal 20 to fiscal 23 across sectors. What is interesting is that last 5 years, we saw degrowth in earnings in consumer discretionary, in corporate banks, in energy, in healthcare for a variety of reasons. Consumer discretionary because some large companies in that space took significant write-offs. And as you know, the uh, discretionary spending was also not doing well. Even pre-COVID, the Indian economy the growth rates were slowing down. Consumer staples continued to grow steadily. Corporate banks, as I mentioned to you, last few years have been very challenging and profits did not grow at all for last 5, 6 years. And as that provisioning is normalizing, the next 3 years profit growth is likely to be almost 50% CAGR. Energy again because commodity prices were falling, and now you can see from this low base, the next couple of years growth is likely to be quite good. Healthcare was had very different challenges. In fact, 5 years back, 6 years back, the margins in this sector were not sustainable. They were extremely high because the generic pricing environment in US was quite good. As the generic prices in US have come down, the sector's profits did not grow. But now that pricing environment is bottoming out, the expectation is that this sector should also grow quite well. And of course, they have cut costs quite sharply in this period. IT continues to grow steadily. Metals has done extremely well because of or the higher CAGR is a result of the very high metal prices. That 1 year profit growth is impacting 3 years CAGR. That is how you should look at. Retail banks continue to grow at a steady pace, though you can see in retail banks the growth is likely to slow down from 20 odd percent, 13 odd percent. This is because the credit growth has slowed down in the economy, and also the competition in that space has intensified significantly. And the banks that were suffering from corporate NPAs have made aggressive inroads into that space, and therefore, of the leaders in retail banking space, the growth is coming down. And also, these companies have become extremely large. And when you become large, it becomes very difficult to continue to outgrow the sector average. Utilities, as you can see here, the growth has been fairly steady. I think this was a slightly detailed overview of the profit growth across sectors, and I thought I'll cover it in this because there are typically quite a few questions around various sectors. Let me now move on to the next slide. And can we go to the next slide, please? Yeah, so thank you. So this is a snapshot of this is an interesting observation. In last few years, many mutual funds or active managers have not done well. So I thought, let me give you a perspective as to what happened and why the outlook is probably slightly better going forward. So the chart at the top gives you the Nifty returns for each of the years from 2005. And it also gives you the top 5 contributors to Nifty returns over the years. And what you will see is that in calendar 2018, 19 and 20, the contribution of 5 stocks to Nifty returns ranged between 80% to 150%. This was way above averages. And in this kind of environment is very difficult for active managers because mutual fund portfolios typically have 30, 40, 60 stocks. And therefore, for such diversified portfolios, it's very hard to outperform if just 5 stocks are contributing to 80 or more than 100% of the Nifty returns also. This is beginning to change now. And you can see in the 3 months, this data we have not updated for the month of April, but the same trend continues. But in Jan, Feb, March of 2021, the contribution of top 5 stocks to Nifty returns is just about 50%, the top 5 contributors, which is okay, which is a far better situation to manage. And that's why you can see in the bottom, I will not go into the details of this, but a large number of active managers were underperforming as on December 17. the table at the bottom right hand side. And if you see the situation today, the sorry, I am extremely sorry, I messed it up. As on December 17, prior to 2018, the most schemes were outperforming. And but as on March 21, you will see that a large number of schemes are underperforming. And this underperformance in last 3 years has to be seen in view of the very concentrated movements of the markets. And the basic message is, I feel that as the markets become more broad-based and are less driven by a few stocks, I think this environment will be more conducive for active managers, and hopefully meaningful number of active managers will be able to beat the indices. Moving on to the next slide. This gives you a snapshot of the valuations across sectors. The top row gives you the current valuation multiples of the various sectors. The next row gives you the 10-year average valuations. And the last row gives you the premium or discount of the current valuations over the 10-year averages. And what you will see is that this is a very, what should I say, skewed market. And it is also showing up in the standard deviation of valuation across sectors. And you can see that the sector valuation divergence is at an all-time high. We have read that value has underperformed for last 10 years globally also. And I think the same outcome you are seeing it here. When divergence in valuations becomes very skewed, very large, it means that some sectors are deeply undervalued and some are overvalued. So at the top, you can see that sectors like automobiles, consumer staples, consumer discretionary are trading above their long-term averages. The oil and gas above premium has to be seen in the context of one company, which is a conglomerate, and that is what is influencing this. But if you look at most other companies in that space, this is not the case. Even cement and IT companies are trading at a premium to the longer term averages. Pharma is at a slight premium. Private banks are in line with long term averages. And this metals and mining, I think this you should ignore, because this chart looks at multiples, just P or EV to EBITDA. But cyclical businesses trade at very low multiples when cycle is very high. So I think in a way this column is misleading, because while multiples are lower, but the profitability is at lifetime highs. And therefore, I mean, as Peter Lynch has said, that cyclical businesses should be bought at high multiples and sold at low multiples. So I don't think you should read too much into this particular sector. Tobacco is at discount. There are concerns around ESG, and it is not a preferred sector. I think while that can change over time, what is more concerning could be is that how the habits of smoking could have changed in the last 1.5 years. In India, most people hesitate to smoke in homes in front of either elders or children or wives. And if you haven't smoked or smoked a lot less in this extended period, what impact this has on tobacco consumption going forward, I think could be a concern. The PSU banks and electric utilities are trading at significant discount to long-term averages. And this is one space, I think at least the stronger companies in these spaces, I think offers considerable value. This was a snapshot of how the various sectors are trading. I think some premium to longer term averages is also justified due to the much lower cost of capital that we are having today. And so if 5-10% premium, I don't think we should read into much. But if the premium is far more, then I think we should evaluate those sectors more carefully. Yes. The next slide, this basically highlights to you once again that the impact of low cost of capital. And if you have if cost of capital drops by 1%, it increases the fair value by roughly 10%. And so if cost of cap, even if profits are less in fiscal 21, so this is a theoretical exercise. Uh, if you make 10 rupees profits in fiscal 20 before COVID, even if that falls to 5 by half in fiscal 21, but if you work with a lower cost of capital, the fair value increase is between 20 to 30% for 2 or a 3% drop in cost of capital. I think while everyone is focused on the economic challenges, the lower profits, I think people have missed the impact of lower cost of capital on stock markets, and that is what uh, is a explains how stock markets have done across the world. Now, moving on to the second last slide, the uh, this is there is a big debate in India, PSUs, good or bad investments. I thought I'll share with you some thoughts here. It is interesting to note there is an index called the Bsc Bsu Index. Uh, it's the blue line and the red is the Sensex. You will see that between 2000 till 2017, the returns of the two indices were same. So for 17 years, PSUs delivered same returns. In last 3 years, however, they have sharply underperformed. I think the reason for this was not profit growth of PSUs. As you can see in the table in the middle, the profit growth of PSUs was actually better than the broader markets. I think the reason for this underperformance was the ETFs, which to my mind was not a great instrument to reduce stakes by the government. Fortunately, the Pump Secretary has said that ETFs will not be a preferred option for the government. And focus will be on strategic sales of businesses. As you know, probably companies like BPCL, Air India, Concor, Shipping Corporation, BEML, these are in various stages of strategic divestment. And I think the BPCL management on a recent call said that they, by December this year, hopefully money should be transferred by the buyer, successful buyer, and the bids should be called, I think, by June. I could be slightly off here by a month or two. And due diligence is currently going on. They have given access to a digital data room. Physical site visits, whenever things open up, should be possible, and quickly things should move from there on. I think this COVID has delayed the strategic sale process by quite a bit, but hopefully in the current year, we will see the first few successful strategic divestment or privatization of these companies. I think that will be a landmark development coming after a gap of almost 17, 18 years. And this, I think, should be positive for PSUs. In certain areas, I think PSUs are very strong, they are well managed, and because of the price performance, the sentiment has been quite weak. But I think and hope that the strategic divestments will bring out the real value of these companies and also improve the market's perception towards these companies. The last slide now, I've taken slightly longer than what I had planned, but hopefully I've answered quite a few questions in this. I think to summarize, I think COVID has been a greater social problem. The second wave has been a greater social problem than economic one. Profit growth has behaved quite well. Stock markets are forward looking. They focus on the future and not on the past. Profit growth, profit impact, profits have actually grown in this period, most surprising. Cost of capital has had a positive impact on the stock prices. And even today, the valuations in India in aggregate terms are near long-term averages, though of course there is considerable variation in valuations across sectors. The last 3 years, index movements were very uh, concentrated that impacted active managers. As markets are becoming more broad-based, I think the performance of active managers has room to improve. The key risks, I think I don't have to say, but if COVID wave, second wave is not controlled, it is a considerable risk. Though we are optimistic, numbers are improving in India, and many other countries have also come out quite well. This a sharp increase in crude prices, good for Middle East, but not so good for countries that import crude. But I think our foreign exchange position is extremely strong. So a $5-10 movement, I don't think changes much here. And I think sharp FPI outflows, as and when they take place, could lead to some corrections. It would not be a challenge for the economy, but we have seen in the past deep corrections in the markets are a result of FII selling. But I always look upon these developments as a opportunity to invest because and one has always seen that the best times to invest in Indian markets were when FIs were a significant seller, whether it was 9/11 or Lehman or tapering or even early part of last year. And finally, I think the big risk, a sharp increase in yields in US especially, I think will could lead to volatility in stock markets, not just in India, but across the world, if and when that happens. So let me stop here and thank you once again for a very patient hearing and happy to answer any questions.
Thank you very much, Mr. Prashant Jain, for this exhaustive presentation. I think many questions that people were asking, I think you almost answered on a step-by-step basis, especially when it came to market sectors performance. But from a simple, common average investor perspective, he is seeing the market at an all-time high. The small caps and mid caps have all run up to to its to new highs over the last few months. So the question that is there in the mind of the investor is: should he be focused more on equity, or should he look at more diversification, like do more of balance advantage fund type of investments, or what should be his call on equity at this point of time?
See, this is a question that always is on top of everyone's mind, and I think the answer also is the same. That equities are extremely hard to forecast short to medium term. But as I tried to explain, Indian valuations in India are not excessive, and last 15-year returns are just about 11% CAGR. I think these are reasonable markets, and the cost of capital is very low. The interest costs are extremely low, and I think it should be possible for equities to deliver uh, decently high returns compared to the low cost of capital. And see, I think it is always a challenge when you see a sharp rally in the markets in the immediate preceding year. But please remember that number is very high because of the very low base or the depressed base of the market. Go back 5 years and look at the index returns today. Go back 10 years and look at the index returns today. I think that will give you a more balanced view of the markets. See, the challenge with equities, and that's why Warren Buffett has said that EQ, emotional quotient, is more important in markets than IQ, than intelligence quotient. Because when markets were falling last year, people were worried and no one was investing. So it was a great opportunity for someone who thought longer. And today people are worried because markets have rallied and some people think you have missed the bus. I think while to expect people to invest last year is probably not reasonable, because unless you are really conversant with markets, I think the best people can do and should do is to think long term in equities. See, people worry too much about timing the markets. And let me give you a simple example. Let's say, I'm saying just randomly, let's say 10 years back, or let's say 10 years back, the market was 20,000. At that point of time, whether you invested at 18,000 or 22,000 appeared to make a big difference. It appeared to be decent volatility, 2,000 point fall or rise, 10% movement up and down. But today, after 10 years, when index is at 50,000, whether you invested at 18,000 or 20,000 or 22,000 makes a much smaller difference. I think, and that is what is often said in the markets, time in the markets is more important than timing the markets. The markets are always volatile. I think 5, 10, 15% volatility year to year is normal to equities. I think, but if you give equities some time, then I think over time, equities have yielded better returns than fixed income. And I don't see any reason why that should not happen this time around, especially because, as I explained to you, the external environment and the India environment both are better for the economy post-COVID than they were pre-COVID.
I think you also touched upon it in your presentation was on we have seen commodities prices rally quite a bit. And now we're also, this is along with say, even oil prices have moved. And for instance, we are reading that the petrol price in India is crossed 100 in many places. And we have a very strange situation that where, the rupee, which was depreciating a few months back, is now correcting, mainly on account of dollar depreciations. So where do you see this in terms of inflation, interest rates on the whole, because of this? This is something that has happened in the recent past.
I think this is a very top of the mind question, but I don't think the answer is very clear. And I think inflation could be there for some time because what has happened, the massive fiscal and monetary stimulus across the world have improved the demand conditions. And when people are getting dollars sitting in their homes, demand will go up. And governments are also focused on increasing infra spends, which is again commodity intensive. And we also know for a fact that last 10 years, the capital capex cycle was very weak. So which means the world has not invested in creating new capacities. On top of that, there are two more developments. One is there is a shift towards green fuels, ethanols and all. So a reasonable part of the edible oils consumption is probably being diverted, or agriculture produce is going towards replacing fossil fuels. And because of the impending arrival of fossil fuels or green energy, it is likely to expect, reasonable to expect that investments in that space would have also taken a backseat in the last few years. So I think it is possible that inflation may surprise us on the upside, because when you stop investing in new capacities, if demand does not come down, it is price hike is inevitable. And that is something which I worry about. I don't have a clear answer to those. I think the equity investor should worry less about inflation than the bonds investor, because equities are a hedge against inflation. If prices go up, it means companies are getting better prices. If steel prices go up, steel companies get better prices, and eventually the car companies will pass it on to the consumer. I think the inflation may not impact the profit growth or value of the businesses, but it could be negative for bonds, because eventually interest rates will have to go up if inflation goes up, and bond investors may get negative real returns for some time. One related development is the higher tolerance of many central banks across the world to negative real rates. Earlier, central banks used to act in anticipation of inflation. Now they are saying over time inflation will come down, and I don't want to increase interest rates. So I think this is a new tool that governments across the world and banks across the world, central banks across the world are resorting to, that don't worry about inflation, keep on printing keep interest rates low. I think this will have some impact at some point in the future on interest rates, but I would be a little less worried about equities. But of course, I highlighted the big risk earlier that if and when US interest rates go up meaningfully, it would not be good for equities in general.
There's a specific question on what are your views on the private insurance sector and the possible divestment of LIC that can happen in the near future.
See, I think the insurance sector is a growing sector in India. And I think a development like COVID has highlighted the importance of that sector. And it has prompting a lot of people who earlier were more complacent to take more insurance, either life insurance or health insurance specifically. I think this is a sector that will continue. See, in India, almost all sectors grow, except, even the basic good soaps and shampoos grow at 2, 3, 4% a year. So these are less penetrated industries, so they should grow. The valuations are somewhere close to the average, not very expensive, not very cheap. So return should track broadly growth of businesses. Regarding LIC, I think it is hard to say, take a view today, because it depends on what value LIC issue is priced. So I think it would be very premature to comment on that. And as on date, we have very little understanding or information about LIC.
This is more from a global perspective. We know now India is almost, our market capitalization is almost at 1 time to GDP now. And how do you compare this with from a global perspective? What are the risks that that India and economy could face from events or occurring outside, especially from the US markets and the European markets?
See, for one, India's market cap to GDP is near long-term averages. It is not at an all-time high. I think the US market cap to GDP is near all-time highs. But in all fairness, in US, even the profits to GDP is near all-time high. I don't think it makes much sense to compare market cap to GDP across markets because of the very different composition of various markets. So if you look at, for example, Russia, almost I think 2/3 of the market is oil and gas companies. So this sector typically trades at low P's. So the market cap to GDP there could be a lot less. India has a reasonable share of FMCG companies, pharmaceutical companies, IT sector, which are unique to India. These businesses are not listed in most of the EMs. And therefore, and these are trading at slightly higher multiples compared to commodity businesses. I would say don't simply compare market cap to GDP across countries, because the underlying sector composition is very different. And also the cost of capital is quite different across markets. The growth rates are very different. But it makes more sense to compare a country's market cap to GDP with its own past. And that is what we have presented to you today.
I think you also spent a lot of time on the sector growths that we have seen in the market, and we are seeing a number of questions on sector-specific questions are being put forth. So I'm trying to consolidate all that into one to ask you one question in terms of sector. Which sectors are you are bullish today, and which sector you feel would be the laggards? 2 or 3 sectors in each of these categories. You can give an opinion, please.
Mr. Ramachandran, I will give you an answer which all your investors will get a ready answer every month for all times in the future. So, as someone said, don't give a fish, teach someone how to fish. So I will give you that answer. There are many people like me, many fund managers, many portfolio managers, and each one thinks differently. And each one's portfolio is public. So all you have to do is to go to the respective portfolio and look at the top holdings, or look at the key overweights and the underweights. And every month, believe me, you will know what are the preferred sectors or not preferred sectors of all the professionals. And this is what we also do. So I also track what my peers are thinking, and I never ask them, what do you like? Why? Because I will simply go and look at their fact sheet. So if you look at our portfolios, the funds I run, not HDFC funds, because we have many managers and each one is encouraged to think independently. The funds I run, I continue to be overweight the strong corporate banks in both public and private sector. Corporate banks are banks that suffered from NPAs, corporate NPAs last few years. We continue to be overweight the pharmaceuticals sector. We continue to be overweight the utility sector. And by and large, my funds are underweight the consumer sector because we think it is quite expensive.
I think from an NRI perspective, this is a common question that we put to all people, fund managers we speak to. One is on your views on gold, real estate, and currency. I'm just putting all three in one.
See, again, an extremely difficult one. It is easier to forecast equities than to forecast currencies and gold. But let me give you a perspective. See, I think high inflation is good for gold, but high interest rates are not good for gold. If the US treasuries today are at 1.5%, if they go to 3%, if they go, I'm not saying they will, they might. If they go to 3%, then a lot of people in the world might want to buy US treasuries instead of buying gold. So I think uh, gold is an asset which over very long periods has preserved purchasing power. And I look upon gold less as an investment and more as an insurance. If when everything else fails, gold will still hold on to value. And so I think some allocation to gold is good, but so one can invest. I'm not an expert on either of these three, but I would ideally like to invest in gold, not in very low interest rate conditions, but when interest rates are quite high, because then gold will not be a preferred asset. But as I said, some exposure to gold is good at all points of time. Coming to real estate, then real estate again, it is not a homogeneous asset. If you bought real estate in Nariman Point 30 years back, you have practically lost all purchasing power. It has performed so miserably. If you bought real estate in Parel or Borivali, just 20 kilometers away in Mumbai, you have done extremely well. I think real estate is also localized, but generally I would say a real estate, a diversified portfolio outperforms inflation over long periods. And in India, we are somewhere in the middle right now. The residential rental yields, which were 15% of mortgage rates 5 years back, are today, I would say, one third of mortgage rates. So mortgage is India is 6.7%. Rental yields are around 2.5%. I would say it is not very cheap in India because rental yields are one third of mortgage yields, but over long periods, this could give some returns. I really don't want to comment much. It is extremely diversified. The I think currency should remain by and large stable. That's what I feel. But of course, a sharp increase in US yields, as and when it happens, will strengthen the dollar. That could lead to weakness of the currency. Any sharp increase in oil prices is sentimentally negative for India, though the foreign exchange reserves of the country are extremely strong. I would say rupee should be by and large stable. Any meaningful volatility will be a result of developments around US interest rates or around oil prices. both of which are extremely tough to.
I think, thank you very much, sir, for your time and also patiently answering to our questions. I think we will circulate the presentation to all the people who attended today. I think most of the questions are all, the answers to most of the questions are already there in the presentation. Our team will also be in touch with the investors who have asked specific questions on schemes, etc., to answer their questions. And on behalf of Barjeel, I thank Mr. Prashant Jain, Mr. Simal, and Kabir for organizing this event for Barjeel and for our clients in the GCC. I will now request Mr. Shamsuddin, our director, to formally propose a vote of thanks.
Good evening, Mr. Prashant Jain and more than 400 attendees present in this webinar. It is our 19th webinar. I express my sincere thanks for the attendees. Mr. Prashant Jain has given us a very, very important takeaway. And yesterday was one of the highest index in our history, but still he is strongly recommending to invest in the market with enough, what I can say, reasons for investment. So it was a good opportunity for us to get more confidence to Indian economy as well as Indian capital market. I express my thanks, Mr. Prashant Jain, as well as his team for giving an opportunity for a wonderful information to our investors. Also, I express on behalf of Barjeel and myself for attending this webinar, such a large number, and getting these kind of information. We definitely will give more opportunities for all our investors in the coming weeks also. I thank you once again. Thank you.
In the last 25 years, the returns on various financial asset classes like bank deposit, gold, and real estate have multiplied several times. But there are a few select investments in the Indian capital markets that have had the potential to appreciate exponentially over 100 times. If you had known this at the right time, you would have taken the right investment decision, which is precisely why you need an expert's validated advice when it comes to investing. Welcome to Barjeel, one of the few SCA-approved financial intermediaries in UAE. We are wealth builders, guiding customers since 2001. We have serviced over thousands of them till date, and today we cater to large segments across investor groups. This speaks about our enormous goodwill and their undiluted trust. And we have earned that trust by telling, not selling. We educate you on the investment opportunities that are ideal for you. We then help you make an informed decision, impartial and unbiased, keeping your long-term goals in mind. And with us, everything is long-term, be it commitment, relationships, or success. We offer comprehensive insights across a wide range of products through a holistic approach. We ask you the most important questions, the answers to which will help you focus on your investment objectives. For example, you work for over 30 years. Are you saving enough for the next 30 years? For life goals like children's education, your daughter's wedding, or your retirement. Think about it. You work hard to earn your money. Does your money work hard enough for you? Barjeel, let's build your future. Come, let's talk.